Shalini, thank you very, very much for your kind introduction. Can people down the back hear me? Just put up, you can? That's good. I feel very honoured and privileged to be here today. So I thank Mr. Lee, the Chairman, for their invitation. Distinguished guests, ladies and gentlemen, I'm going to walk through a reasonably busy program, and hopefully all that stands between you and lunch is myself. So I'll do it in a way that hopefully is valuable. I joined the funds industry in Australia in 1970, and the Australian funds industry is just over 50 years old. So I'm not quite a pioneer, but I've been around for most of the time that the unit trust industry has developed in Australia. I'm delighted to be here because I think that Malaysia and FIM and the unit trust industry in Malaysia is going through a significant reform period, and hopefully some of the insights that I bring might help in that process. I'll just get you to go to the next slide, please. Can I get the next slide? So what I'm going to walk through today is just having a look at who is actually influencing the regulatory agenda. I want to have a close look at the Asian economies. I won't repeat too much of what was covered in the last session by Iris, but I just want to cover a little bit of that. Have a close look at the managed fund or unit trust industry. I'm then going to spend a little bit of time about the Australian marketplace. Then I want to start into the importance of regulation and the role that it plays. So I'm going to cover the importance of managing brand, what's happening with regards to self-regulation in Asia more broadly, Australia. There's one of my hobby horses, so I hope that you will put up with this, but global investment performance standards I will cover in a bit more detail, and then I'll wind up. The industry when I joined was one of the key drivers. The third one is competition. I think that the competition, not just in Asia, but the competition throughout the world for pooled investment has improved or has increased tremendously, and many governments are actually encouraging this competitive framework. Okay, next slide. The last slide before I move on, I wanted to point out here, this slide again is a very complicated slide, but the point that I wanted to make here is what's happening pan-Asia. And I think we'll start to hear this comment pan-Asia more and more as time goes on. So what's illustrated up here is all of the mergers and acquisitions transactions that have occurred from 2008 to 2011 from outside of the domestic territory. So these are investments made in other countries, the broadening of investment. And if I put this slide up 15 or 20 years ago, it would have all been red. Most of the monies coming into the Asian Pacific economies 15 or 20 years ago came out of North America or came out of Europe. What this is starting to show is that there is a lot more activity pan-Asia. A lot more companies who have been successful domestically are starting to say, should we look at broadening our footprint? What have we got? What are the assets? What can we actually take from our experience in the domestic area to work outside? The grey chart there, the grey line, is Malaysia. So if you have a look at Malaysia, the investment and this is just financial services only, but the investment into Indonesia and investment into Singapore are very, very significant. And who's investing in Malaysia? I think Japan has been one of the bigger investors, Hong Kong and Japan, one of the bigger investors into Malaysia. Why is this happening? Well, mainly because Europe and the US don't have the available capital they've had before. And in fact, a lot of the available acquisitions, if I put up, what companies have been acquired, a lot of them are Europeans and North Americans actually exiting our market, and that market is actually being bought by Asian investors or Asian companies, and most of those companies are in the financial sector already. Could I have a look at the next slide, please? Okay, I just want to cover now the last 25 years of regulatory developments in Australia in about 3 minutes. So I apologise, but it's going to be quick. But I want to take you back 25 years. So we'll go to the next slide. So what happened just move on to the next slide, thanks. So what happened in 1987 was that Australia decided to do two things. One was float its currency, and two was to open up the financial sector to global competition. One of the reasons why it did this was because it was very heavily tied to the apron strings of the UK for the best part of 150, almost 200 years. And the UK guidance around executive equity plans and employee share plans, personal trading guidelines. One of the ones down here is the industry terms and definitions. One of the issues that you've got with industry terms and definitions is really good marketers, and I'm sure there's a few good marketers in the room here, exceptionally good with words. So what the Industry Association is trying to do is to say the more that we can speak with common language, the more we'll have an informed consumer. So if you start to get too subtle with the words, start to get what I would call too cute, then you start to get a more confused consumer. So the industry really is quite focused on using common terminology. And the last one is really, the last one in blue is around the custodian banks, the investment administrators, and their expectations to report through to pension scheme providers. Then in the grey section in the middle are guidelines around performance and pricing. The Global Investment Performance Standards I'm going to come back to a bit later on, but we've got guidelines around calculating product performance, how you value infrequently valued assets, which sounds strange, but in Australia a lot of our portfolios sit in property assets, in private equity assets, in infrastructure assets, and these are all difficult to actually cut a value. So in the main they've got to be valued every year, but the valuation methodology must be disclosed both in the offer documents and on the website. So the way that it's going to be valued, and if the market moves quickly, they've then got to be valued, and most of them nowadays, infrequently valued assets, are valued on about a quarterly basis. And then the last of the grey ones I've got around investment calculators. As an industry association, we did a study in 2004, and you could put one set of dimensions into a calculator, and you could get a result that varied by 230%. So what we said was the engine behind the calculator to work out how much is my pool going to be worth when I get to 65, had to use consistent methodology. So we've got guidelines around that, and again, fortunately, most of the industry, or all the industry, has adopted it. Then the last lot in the red down the bottom I've got is industry integrity and confidence measures. They're around, the first one is wholesale brokerage arrangements. This is the stockbroker arrangements together with their research. We've got guidelines, risk management for trustees. The third one there, the Financial Services Council Major Disaster Plan we put in place after 9/11. The interesting part in Australia after 9/11 was when the market closed, there was nobody who was prepared to take responsibility. So you go to the Australian Treasury, or you go to the regulators, or you go to the Reserve Bank, and everyone stood back. And it was the Industry Association that ended up getting all the interested parties together and saying, what the heck do we do with a unit price when we don't have a trading stock market? So we've had that major disaster plan in place.